Mic check.
Money check. Mindset check.
This is Mic'd Up Money Reloaded.
Where entrepreneurs talk money,
Strategy, systems,
and execution. No fake hustle, no empty flexing, just real business talk that gets you right.
Mic'd Up Money
Reloaded, talk that strategy, show it. Systems moving, profit growing. Real entrepreneurs already know it. No fake value, better own it. Price meets pain when the bridge is built. Execution turns the vision golden. If the plan is weak, the pressure gets felt.
Mic check.
Money check.
Mindset check.
This ain't just motivation. This is business correction. This ain't just conversation. This is money direction.
You want profit, build the model. You want growth, fix the flow. You want increase, check the numbers.
What you don't know can stop the show.
Mic'd Up Money
Reloaded, talk that strategy, show it.
Systems moving, profit growing.
Real entrepreneurs already know it. No fake hustle, no empty flexing, no more guessing, no more
Stressing, money, strategy, systems,
execution.
reload the vision, rebuild the plan.
Price the value, know where you stand.
Mic'd Up Money
Reloaded.
bumping 96.3 FM. iHeartRadio, YouTube.
Where entrepreneurs talk money,
Strategy, systems.
and execution.
Stop just listening.
Start applying.
Mic'd Up Money,
Reloaded.
let's get it. Let's get it.
Disclaimer. Mic'd Up Money Reloaded provides business education, strategic commentary, and general information. Nothing in this episode is individualized accounting, tax, legal, lending, investment, or financial advice. Debt agreements, tax obligations, ownership structures, collateral, and business conditions differ. Before making major restructuring, borrowing, tax, legal, or personnel decisions, consult the appropriate qualified professional. Welcome back to Mic'd Up Money Reloaded, where entrepreneurs talk money, strategy, systems, and execution. Today, I want to deal with a statement that scares a lot of business owners. Help, my debt is swallowing up my profit. Every month, money comes in, payroll goes out, vendors get paid, credit cards get paid, loans get paid, taxes, software, insurance, rent, inventory, vehicles, contractors, subscriptions, and everybody else with a claim on the business gets paid. Then the owner looks at the bank account and asks one painful question: where is my money? The easy answer is the debt took it. Maybe. But debt may be the pressure you are feeling without being the original problem. Before we blame the lender, I want to examine what happened before the debt payment ever came due. Maybe revenue was earned but never reached the bank. Maybe customers are taking too long to pay. Maybe somebody is stealing. Maybe inventory is swallowing cash. Maybe you are paying for overhead that cannot defend its existence. Maybe your pricing is wrong. Maybe your business model is wrong. Maybe the model is sound, but you are executing it badly. Maybe employees are doing work that never gets billed. Maybe the owner is taking more out than the business can sustainably produce. Maybe you are marketing the wrong things. Maybe you are borrowing to finance confusion. Maybe debt is not swallowing your profit. Maybe your business is bleeding before the debt ever gets its turn. One, profit is not cash. Diagnose the right problem. Before we go anywhere else, understand that accounting profit and available cash are not the same thing. A business can report a profit and still be suffocating for cash. Loan principal reduces cash, but generally does not appear as an operating expense on the income statement. Inventory can consume cash before it becomes cost of goods sold. Receivables can record revenue before cash is collected. Equipment purchases can consume cash while being capitalized. Owner distributions can drain cash without appearing as an operating expense. That means four different problems can all sound like I have a debt problem. A profitability problem means the operation does not create enough economic margin. A liquidity problem means cash does not arrive when obligations come due. A capitalization problem means the business was started, acquired, or expanded with too little permanent capital and relies on borrowing to fill the gap. A solvency problem is more serious. The enterprise may no longer have enough value or cash generating capacity to support its obligations. Those are not interchangeable diagnoses. If you misdiagnose the problem, you can refinance a bad business, cut marketing from a good business, fire productive people, borrow against your house to fund recurring losses, or slash prices when the real issue is weak visibility. Financial intelligence starts with naming the right problem. 2. What created the debt? Before refinancing, consolidating cards, borrowing against personal assets, or opening another line of credit, ask what created the debt. Debt used to acquire productive capacity is different from debt used to cover chronic operating losses. Debt that bridges a temporary receivable gap is different from debt that pays an owner lifestyle the company cannot support. Separate productive debt from destructive debt. Productive debt may finance equipment, inventory with proven turnover, a strategic acquisition, or a controlled expansion with measurable return. Destructive debt repeatedly finances bad pricing, poor collections, owner withdrawals, waste, fraud, tax arrears, oversized payroll, non-performing inventory, or an unprofitable model. If borrowing keeps solving the same problem every month, borrowing has stopped being a financing tool and has become part of the operating model. That should scare you. 3. You need financial intelligence, not just financial statements. Many owners have financial information. They have bank statements, QuickBooks, tax returns, payroll reports, credit card statements, and maybe monthly financials. But having financial information is not the same as having financial intelligence. Financial information says revenue was $125,000, payroll was $42,000, inventory purchases were $31,000, advertising was $7,500, and the income statement showed a $9,000 profit. Financial intelligence asks why revenue was $125,000, which products, services, and customers produced it, which produced the strongest contribution margin, why payroll increased, whether productivity increased with it, whether inventory turned, whether advertising acquired profitable customers, and why the bank account has only $2,700 left. Every meaningful number should eventually answer four questions. What happened? Why did it happen? Is it good or bad in context? What are we going to do about it? Your accountant can prepare the numbers. Your bookkeeper can record the numbers. Your tax professional can calculate obligations. But the owner cannot outsource understanding what the numbers mean operationally. Financial intelligence also distinguishes lagging indicators from leading indicators. Revenue, profit, and bank balance often tell you what has already happened. Inquiries, appointments, proposals, conversion rates, average ticket, inventory turns, billable utilization, customer cancellations, repeat business, stockouts, receivable aging, lost sales, and order backlog can warn you before the financial statements become ugly. One number gives you information. The trend, context, cause, and decision give you intelligence. 4. Is all the money actually hitting the bank? Before reducing expenses, prove that earned revenue actually arrived. Reconcile the entire revenue journey. What was sold, what was invoiced, what should have been collected, what was actually collected, what went through point of sale systems, what reached payment processors, what reached the bank, what was refunded, what was charged back, what was written off, and what simply cannot be explained. If the sales system says $92,000 and only $81,000 can be traced to deposits, receivables, legitimate refunds, documented credits, or timing differences, somebody needs to explain the other $11,000. I don't know is not an accounting category. Cash, checks, credit cards, ACH, Cash App, Venmo, Zelle, online processors, marketplaces, and multiple bank accounts create opportunities for error and theft when reconciliation is weak. Revenue should not disappear between the customer and the bank. 5. Receivables and the cash conversion problem. A profitable company can choke because customers are financing themselves with your money. If payroll goes out every 2 weeks, vendors are paid in 15 or 30 days, and customers pay you in 60 or 90 days, somebody has to finance the gap. Very often that somebody becomes the owner's credit card or line of credit. Build an accounts receivable aging report. Who owes you money? How much is current? How much is over 30, 60, 90, or 120 days? Which customers routinely require collection effort? Which account should no longer receive open credit? Which terms should be renegotiated? Then examine the cash conversion cycle. How long does cash stay trapped in inventory and receivables before returning to the bank? A business can be profitable on paper while using debt to finance the time between paying for work and collecting for work. 6. Internal theft, external theft, waste, and weak controls. Debt pressure makes every leak more expensive. Internal theft may involve unauthorized discounts, false refunds, diverted payments, inventory theft, time theft, personal purchases on company cards, fictitious vendors, duplicate reimbursements, kickbacks, fuel misuse, or unauthorized work for friends and relatives. External leakage can include fraudulent chargebacks, vendor overbilling, contract creep, duplicate billing, cyber fraud, supplier price increases, unnecessary bank charges, and claims or refunds that are not reviewed. The lesson is not that everyone is a thief. The lesson is that trust is not an internal control system. Not every lost dollar is stolen. Some is normalized waste, rework, overtime caused by poor planning, spoilage, duplicate software, unused equipment, excess inventory, rushed freight, avoidable late fees, poor quality, warranty redo work, or supplies used without control. A $500 weekly problem is roughly $26,000 a year. 5 normalized $500 problems can become $130,000. 7. Bring back the overhead eliminator. One of the most important questions in business is brutally simple. Why are we paying for this? Every recurring expense should be able to explain how it supports present income, protects income-producing capacity, satisfies a legitimate requirement, supports a specific future activity, or serves a discretionary purpose that management consciously accepts. The problem is that discretionary spending is good at dressing up like overhead. An upgraded vehicle becomes marketing. An oversized office becomes professional image. A family member's salary becomes essential support. 10 software subscriptions become technology. Meals become business development. Travel becomes networking. Take the general ledger, bank statements, credit card statements, subscription lists, leases, vendor contracts, and insurance bills. Question every meaningful charge. What did we buy? Why did we buy it? Who authorized it? What activity does it support? What return or protection does it provide? Can it be renegotiated, reduced, replaced, or eliminated? Every expense should have to defend its chair at the table. 8. Do you actually understand your business model? A lot of owners can describe what they sell, but cannot explain how their business is supposed to make money. They know the product, the service, the price, and the hours. But ask where the best margin is, which customer generates the greatest contribution, which inventory turns fastest, what the break-even volume is, or how much capacity must be sold before the next employee becomes profitable, and the conversation gets quiet. A business model is not merely, I own a store, I run a salon, I sell consulting, or I sell books. The model explains how the organization converts customers, inventory, labor, assets, expertise, intellectual property, and operating activity into sustainable cash and profit. Purchasing cannot operate independently from sales. Sales cannot operate independently from pricing. Pricing cannot operate independently from cost. Marketing cannot operate independently from inventory. Payroll cannot operate independently from productivity. Debt cannot operate independently from cash flow. Owner compensation cannot operate independently from profitability. The business is a system. Stop managing your business to look successful. Start managing it to be economically successful. 9. The inventory trap, shelf rich and cash poor. Some owners buy too much inventory because they want the store to look full. A full store may look successful while the bank account is starving. Inventory sitting on a shelf is cash sitting on a shelf, and some of that cash may be financed with debt. Separate performing from non-performing inventory. Performing inventory turns at an acceptable rate and produces acceptable gross profit dollars. Non-performing inventory sits, ages, becomes obsolete, gets damaged, gets stolen, gets marked down, and eventually teaches the owner an expensive lesson. The opposite mistake is failing to buy deeply enough in inventory that actually performs. Proven fast-moving items may qualify for quantity discounts, freight savings, rebates, preferred vendor terms, promotional allowances, or other incentives. Some businesses have too much of what does not sell and not enough of what does. That is not merely an inventory mistake. It is poor allocation of capital. A full shelf can hide an empty bank account. Financial intelligence recognizes inventory for what it is: cash that has not yet completed its journey back to cash. 10. Service businesses can be wrong in both pricing directions. Service businesses often make one of two opposite pricing errors. Some charge so much relative to their demonstrated value, positioning, trust, and market demand that very little business closes. A beautiful margin percentage on zero transactions is still zero. Others charge too little. Their calendars stay full. Everybody loves them. They work nights and weekends. They hire because they are overwhelmed. Revenue goes up, but consistent, good profit never arrives because every additional customer produces too little contribution toward overhead and profit. Busy and profitable are not synonyms. The right question is not simply whether customers will buy at a price. The better question is whether you can consistently attract enough of the right customers at a price that covers direct cost, contributes to overhead, compensates capacity, rewards risk, and creates sustainable profit. 11. Product businesses. Stop featuring what you cannot deliver. Product businesses sometimes promote items they do not have while ignoring items that need to move. Imagine advertising a book that is not in stock, creating an order, placing a one-off purchase, paying extra freight, waiting, communicating delays, and consuming staff time while thousands of dollars of books already sit on the shelf unpromoted. Marketing strategy should understand inventory strategy. Purchasing should understand sales strategy. Sales should understand margin strategy. If you have profitable, seasonally relevant inventory in stock that needs to turn, why spend marketing money creating demand for something you cannot immediately deliver? There are legitimate reasons to promote out-of-stock or special order products. Pre-orders, drop shipping, testing demand, or deliberate assortment expansion. But that should be a conscious model decision, not evidence that marketing and inventory management are disconnected. 12. Your customers may be telling you where the profit is. Customer feedback is not merely a customer service matter. It can be profitability intelligence. Customers reveal what they value, what they repeatedly request, why they do not buy, why they leave, what they cannot find, what they consider too complicated, what they are willing to pay for, and what would make them return. But do not confuse stated preference with revealed preference. Customers may say they want a product and then never buy it. They may ask for longer hours and never show up. They may say price is the problem when the real issue is trust or value. Track what customers say, but verify it against what they actually buy, rebuy, return, abandon, pay full price for, and refer others to. When customer behavior and financial performance point in the same direction, pay attention. The market may be trying to tell you what your profitable business actually is. Owners can literally borrow money to continue financing the business they imagine, while customers are trying to show them a better model. 13. Things and services do not sell themselves. A good product does not guarantee demand. Customers have to know it exists, understand what it does, believe it solves a meaningful problem, trust the seller, understand the value, and receive a reason to act. What looks like a product selling itself may actually be the accumulated return on years of brand building, customer experience, distribution, referrals, advertising, promotion, and reputation. Do not confuse marketing, advertising, promotion, and sales. Marketing is the broader strategy. Who is the customer? What do they value? How are we positioned? What is the offer? What should it cost? And where will we reach them? Advertising is paid communication used to place the message in front of an audience. Promotion is an activity or incentive designed to stimulate attention, trial, traffic, or action. Sales converts interest into transactions. Advertising gets their attention. Promotion gives them a reason to move. Sales gets the money. Financial intelligence tells you whether any of it was worth doing. Before declaring that inventory does not sell, ask whether it was marketed, displayed, demonstrated, recommended, bundled, listed online, supported by trained staff, or placed where customers could see it. Sometimes the merchandise is not dead, the marketing is. But do not throw advertising dollars at an offer the market has already rejected. Marketing is not magic. It cannot permanently rescue a weak product, terrible experience, or broken value proposition. Advertising communicates. Promotion motivates action. Sales converts. Financial intelligence judges the economics. 14. Marketing must produce economically worthwhile customer behavior. Owners frequently say, "We spent $5,000 on marketing." That tells me what you spent, not what you accomplished. What did the campaign generate? How many qualified leads? How many appointments? How many sales? What acquisition cost? What average ticket? What gross profit? What contribution margin? What repeat behavior? You can spend $10,000 generating 100 customers and still lose money. If the acquisition cost is $100 per customer, but each customer produces only $60 of contribution after fulfillment costs, congratulations, you successfully scaled your loss. Promotions also need economic discipline. Constant discounting can train customers to wait for a sale. A promotion should have a strategic purpose. move aging inventory, increase trial, increase average ticket, fill unused capacity, introduce a new service, bundle products, encourage repeat business, or acquire customer information. Revenue created by a promotion is not automatically profitable revenue. 15. Question payroll, including the owner. Payroll is often treated as untouchable even when it is one of the largest expenses. Evaluate roles against output, productive capacity, income support, customer experience, compliance, quality, and risk protection. What does the position own? What would fail if it disappeared? Could technology reduce workload? Could responsibilities be redesigned? Then question owner compensation. There's nothing wrong with earning money from your company, but the owner's desired lifestyle and the company's present economic capacity are different numbers. Salary, draws, distributions, vehicles, insurance, travel, benefits, family payroll, and personal expenses paid by the company should be analyzed together. If the business produces $180,000 of economic benefit before owner compensation and the owner extracts $220,000 because the household needs it, the business is not funding the lifestyle. The balance sheet, vendors, taxes, or lenders are funding the difference. 16. Business, personal, or hybrid. Commingling destroys management intelligence. A personal expense gets paid through the company. A business expense gets paid personally. Somebody says they will fix it later. Later never comes. Soon the financial statements can no longer tell the owner the truth. Classify material transactions as business, personal, or hybrid. Document legitimate business purpose. Treat personal spending as personal. For hybrid items, use a defensible allocation and proper reimbursement or accounting treatment with professional guidance. If company overhead is reported at $52,000 a month, but $11,000 is really owner lifestyle or discretionary personal benefit, management may misdiagnose the business. Conversely, if the owner personally pays $4,000 per month of legitimate business costs and never records or reimburses them, the statements can make the company look healthier than it is. You cannot fix numbers that are not telling the truth. 17. Find the money you already earned. Cost cutting gets attention during debt distress, but revenue recovery can be faster. Look for uncompensated activity. Extra meetings, rush service, delivery, travel, setup, customization, revisions, research, change orders, supplies, follow-up, or expanded scope that the customer receives but never pays for. Then identify unreimbursed expenses and unbilled activity. Are client-specific third-party costs recoverable under your agreement but never invoiced? Is completed work sitting in a system waiting for billing? Are change orders approved verbally but undocumented? Are recurring services still being delivered under an old billing schedule? Also, examine discounts, waived fees, credits, free upgrades, extended terms, returns, refunds, chargebacks, warranty work, and redo work. The published price may be correct, while the realized price is terrible. Before borrowing another dollar, collect the dollars the business has already earned. 18. Growth can swallow cash too. Growth is not automatically the cure for debt. You can grow yourself broke. More sales can require more inventory, payroll, supplies, equipment, receivables, customer service, vehicles, or facilities before the related cash arrives. Measure capacity and utilization before expanding. If equipment can produce $50,000 a month and you are producing $23,000, another machine may be unnecessary. If a team has available billable capacity, hiring before selling the capacity can deepen the cash problem. Seasonality matters too. If the business predictably struggles every January through March, that is not an emergency. It is a planning requirement. Retained earnings and minimum cash reserves should be part of the model, so every slow season does not become another credit card cycle. 19. Understand the debt stack. Many owners do not have one debt problem. They have a stack. Business cards, personal cards used for business, equipment notes, lines of credit, SBA debt, merchant cash advances, tax liabilities, owner loans, vendor financing, leases, and perhaps daily or weekly ACH obligations. Each obligation looked manageable when it was created. Together, they can suffocate operating cash. Build a debt schedule showing balance, rate or factor cost, payment, frequency, maturity, collateral, personal guarantee, variable or fixed terms, and what the debt originally financed. Pay special attention to expensive short-term financing and daily or weekly withdrawals. The nominal balance may not look enormous, but repayment frequency can destroy operating flexibility. Also understand covenants, cross defaults, collateral, and personal guarantees before assuming refinancing is a simple answer. 20. Behavioral economics. Why owners keep funding the wrong thing. Debt distress is not purely mathematical. Loss aversion makes owners protect failing investments because shutting them down feels like defeat. Sunk cost bias makes them keep funding something because of what they already spent. Present bias makes today's comfort more important than next year's stability. Optimism bias keeps saying, next month will be better. Status quo bias protects bad vendors, bad contracts, bad subscriptions, and bad processes because changing them is uncomfortable. Confirmation bias is especially expensive. The owner believes a product is the best, an employee is indispensable, customers love an offer, or a location is essential. The numbers say otherwise. Financial intelligence forces you to ask, what do these numbers know that I do not want to know? Then there is debt normalization. A revolving balance, annual line renewal, tax arrears, or seasonal borrowing stops feeling like an event and starts feeling normal. Debt becomes dangerous when borrowing stops feeling like an event and starts feeling like an operating procedure. And ego may be the most expensive bias of all. The vehicle stays, the office stays, the image stays, the lifestyle stays, working capital disappears. You cannot flex your way out of negative cash flow. 21. The 72-hour cash recovery review. For the next 72 hours, stop treating the financial statements as historical documents. Use them as investigative evidence. First, reconcile revenue from sale to invoice to collection to deposit. Second, age receivables and identify what can be collected now. Third, review every recurring and significant cash outflow. Fourth, separate essential, productive, protective, future-focused, and discretionary spending. Fifth, examine payroll and owner compensation. Sixth, identify uncompensated work, unbilled revenue, unreimbursed expenses, discounts, credits, refunds, and rework. Seventh, inspect pricing, gross margin, contribution margin, and unit economics. Eighth, separate performing and non-performing inventory. Ninth, compare customer feedback and revealed purchasing behavior to what you are stocking, marketing, and selling. 10th, review marketing, advertising, promotion, and sales conversion economics. 11th, inspect theft, waste, and controls. 12th, separate business, personal, and hybrid transactions. 13th, build the complete debt stack and project 13 weeks of cash. Only after that review should you decide what your debt problem actually is. One company needs refinancing, another needs a price increase, another needs collection discipline, another needs to eliminate $8,000 of unnecessary overhead, another needs to stop owner withdrawals, another needs internal controls, another needs to change inventory, another needs to market what it already owns, another needs to redesign the revenue model, another must admit that the current operation cannot carry the organization built around it. Business model reality check. Questions to ask out loud. What exactly produces our strongest gross profit dollars and contribution margin? Which products turn fastest and which products are tying up cash? Which services keep us busy but do not produce enough consistent good profit? Which customers create the greatest economic value and which consume resources without adequate return? What are customers repeatedly requesting that we do not stock, offer, or communicate well? What are we stocking or offering that customers repeatedly ignore? What are we marketing that we cannot efficiently deliver? Are we priced too high for our demonstrated value, too low for our cost structure, or simply communicating value badly? What activity looks successful but does not create economic value? If we erased the company name and only looked at the numbers, would we design this business the same way again? Toolkit segment. The companion debt is swallowing my profit. Cash Recovery Toolkit is not a debt pay down worksheet. It is a diagnostic operating system designed to help an owner identify whether the company has a profitability, liquidity, capitalization, execution, control, pricing, inventory, marketing, or actual debt problem. Debt pressure and 4-problem diagnostic, profit to cash bridge and 13-week cash forecast, revenue to bank reconciliation and receivable recovery, revenue quality, unit economics, pricing, and contribution analysis, business model, inventory, customer profit signal, and demand analysis, marketing, advertising, promotion, and sales economics, payroll, owner compensation, commingling, and every charge review, uncompensated activity, unbilled revenue, and reimbursable expense recovery, waste, fraud, theft, capacity, growth, seasonality, and concentration reviews, debt stack analysis, decision triggers, and a 30-day cash improvement scorecard. Strategic hustling moment. Before you refinance the debt, refinance the decisions that created it. A new loan can reduce a payment. It cannot fix theft, bad pricing, uncontrolled spending, non-performing inventory, free work, weak billing, owner excess, bad marketing, or a business model that does not know where its money is made. Debt relief without operational correction can simply give a troubled company more runway to make the same mistakes. Closing. So when you say, help, my debt is swallowing my profit, ask a better set of questions. Is all the revenue reaching the bank? Are customers paying fast enough? Is someone stealing? Are we paying for waste? Is the overhead justified? Is payroll economically supportable? Is owner compensation supportable? Are prices carrying the real cost of doing business? Are we leaving earned money unbilled? Are we buying the right inventory? Are we marketing what needs to move? Are we listening to customer behavior? Are we generating profitable demand? Are business and personal spending commingled? Are we growing faster than cash can support? And after all of that is corrected, can this company actually carry its debt? Sometimes debt is the problem, but sometimes debt is simply the receipt from years of problems nobody corrected. Find the leak, fix the economics, recover the cash, then attack the debt. This is Mic'd Up Money Reloaded, where entrepreneurs talk money, strategy, systems, and execution. Subscribe to Mic'd Up Money Reloaded on all social media platforms and re-listen to this episode on our podcast on major podcast platforms. Please like, share, and comment Great Business Education to support and promote our channel.
Mic'd Up Money Reloaded.
Bumping 96.3 FM. iHeartRadio. YouTube.
Where entrepreneurs talk money, strategy, systems, and execution. Stop just listening. Start applying. Mic'd Up Money Reloaded.
Let's get it.